here from Khurana and Khurana. I'll be moderating today's webinar on royalty-based IP valuation approach. I'm just admitting a few colleagues who are sort of joining in, and I'll sort of do that on a rolling basis. Bhumika, please help me out for that. And at the outset, thank you very much for taking our time. We've got an overwhelming response for the webinar. Thank you very much for the support. As far as LESI is concerned, we've got a tremendous platform and a great set of speakers today for the session that we have on a very unique topic that I think should attract a lot of attention from the Indian audience as well, given the tremendous growth of intellectual property portfolios that Indian entities are seeing. I think before I move forward, I must thank the two speakers on, I've been very privileged to moderate today. I have Dr. Fernando here with me, I think who has significant experience coming in. He leads the IP valuation committee for LESI for Britain and for Ireland, and has been in the industry for close to about 20 years. Significantly experienced, and all his bio was mentioned in the brochure as well. So I won't sort of take time to read the whole out of it, but comes from an engineering background and massively qualified on valuation. I think we wouldn't have a better person than Dr. Fernando for a topic like this. Then we have Dr. Anke Nestler as well. I think she's based in Germany, extensively renowned for undertaking valuations primarily for IP disputes and assisting out courts in terms of arriving at the appropriate and the fair value as far as the dispute is concerned and the IP in context. She's also the senior managing director of FTI Consulting, and as a result of which brings on board I think the two best people around in the space to add value, who probably do valuations in and out on a daily basis. So thank you again, both of you, for joining in. We'll keep it interactive. We are short and sort of we have to be on time from that perspective. I just before starting wanted to give a quick outline of for colleagues who are new to valuation. Some of them are part of LESI and therefore have experienced sessions on the subject in the past, but I think I understand several of them are not. And therefore, just in the interest, a usual intellectual property valuation would be carried out for several strategic objectives, including but not limited to the ones mentioned on the slide, from when you're trying to license an IP or monetize an IP, or when you're trying to finance or obtain a financing in view of the IP that you've obtained, or attract investment, or any of the other objectives that are mentioned. Typical methodologies for undertaking valuation, as we are all well aware of, range from cost-based approach, where we are basically looking at how much cost went into the development of the IP and scale the value based on the factor of cost. And then we do an alternate approach where we look at a similar technology that was licensed or monetized separately and try to value based on the comparables as to what that got licensed at, or what royalty rates were prevalent for that technology, and draw parallels and identify market rates accordingly from a valuation standpoint. Then it could be the most prevalent income-based approach, where the intention is to project the revenues of a company and identify the contribution of IP within the projected revenues, and deassociate the risks associated, the tax considerations, and identify the core contribution of IP after the mitigation of the risk, and then discount it in the net present value terms. And then the fourth one, which is the topic of interest today that we'll focus on, which will essentially be royalty-based approach, in which instead of identifying the contribution of IP, we assume, and we are in the shoes, for instance, of a licensor, and say that if we were to license the IP, what kind of royalty would I be getting? And based on that royalty stream, I will discount it back for the economic life of the patent. So I will project the revenues for the company, for the licensee, or for the company that I license it out to, for an economic life of the patent or the IP in context, and then discount the royalty contribution of the same, which could be 2%, could be 5%, depending on the technology and interest, and discount it back. So a very exemplary, very, very high level working would look like this. This is a very simplistic view of the exercise where, for instance, if the technology pertains to a VAS, which is a value-added service which is given to a bank by a technology provider, and that technology provider holds an IP on it. And if the banks earn, for instance, for the next 5 years or 7 years of economic life of the patent, these kind of revenues in whatever dimension they may be from a currency standpoint, and then the royalty is calculated as, for instance, 3% of the same or 4% of the same, and then you calculate therefore the royalty, and then you apportion the taxes, you apportion also the discounts that are available by virtue of the risk that the IP poses in terms of validity, in terms of enforceability, in terms of claim construction, and identify what the actual contributory factor for the royalty income would be in the net present term, in today's term. And then we aggregate it to present value and identify the value. And therefore, this becomes a very simplistic representation of how a valuation would look like. Now, this, by virtue of the tax practices being different in every country, by virtue of the discount rates being different in every country, by virtue of the discount as far as the risk associated with the IP being different in every country, the methodology and the pedagogy would change. But then the fundamental premise remains around the same, where, for instance, in this instance as well, we identify the IP generated, we identify what kind of royalty rate would be applicable, what kind of royalty would be earned, what kind of tax obligations will there be. We also look at what kind of risks would there be. We adjust the risks in the royalty rates and then bring them down to the present net present value in terms of today's instance is concerned. So this was just as a very background instance to how a valuation could be approached and what the basic fundamentals of valuations look like. Now, from here on, very happy to obviously chat around with Dr. Fernando to start with. Dr. Fernando, of the four approaches or of the approaches, where do you see royalty-based approach being utilized? What quantum, what kind of scenarios utilize royalty-based approach? If you can throw some light on that in the territory that you primarily work in.
Yeah, thanks very much, Tarun. Yeah, it'd be a pleasure to describe that. Let me take a step back just for everyone. And please, anyone that would want to ask any questions while we're presenting, please, if you can send them through the chat, and then we'll try to get either during the talk or at the end of the webinar. But yeah, pleasure to be here. Thanks very much. Let me start with the following, I think, consideration. What I want everyone to think about is, first, you have to consider what business opportunity or company that you're looking into. And if we just take a step back, think about macroeconomic considerations. Which country, which jurisdiction, what are they trying to do? As Tarun said, what are the risks that are inherent at the macro level? Then what I submit to everyone as well is think at a company level first. The first things that I do is I think about what investments or how much cost has been included into the entire company or the business. When were these investments made? Are there any transactions that have occurred recently or in the past that give me a sense of maybe the company value, pre and post money valuation, how much was raised, or is it at a very early stage? So these touch upon the first couple of methods that were described. The cost approach is saying how much was invested to date, or how much investment was acquired, right, and deployed. The market rate approach is equally important. It gives us a sense of what is the market really telling us about the value of a business opportunity and the underlying intangible assets and tangible assets, right, of a business opportunity or company. But transactions are one of the most important valuation. That is the core of the valuation, right? It's two independent parties acting freely in the marketplace, trying to come up with a sensible transaction value. So that gives a really good indication. Now, the other thing that needs to be done is, if you think about it in the company level, the way I do things is that I look at all the intangible assets that make up that company, and I think about what I'm valuing. And I think to myself, how important is, let's say, those IP assets or those intangible assets to generate the revenues and profits of the company? And that's when the relief from royalty methodology comes in nicely. Now, the relief from royalty is basically on a It's used on a future income approach, which is the third method. And there, I think the important bit is to think about this, right? If you did not own your own assets and you had to pay somebody else, or if you had to pay a royalty rate to access your own intangible assets to reach your revenues and your cash flows and your profitability, how much would you pay? In essence, what I like to submit to everyone, this is a profit splitting exercise, right? So when you look at the entire business and it has a profit margin, and you think that the IP represents, let's say the profit margin is 20, and you think the IP represents 25% of that, then a 5% royalty relief from royalty rate could be a good starting point. But there's so many different projects in consideration one needs to make that. This is what's important. And then a lot of other considerations on specific IP risk. But with that, I think with that opening sense that I want to try to show you, like, think about company, think about what the company is made of, think about if it didn't own those IP assets, how much it would pay in terms of a royalty rate. Those have to be maintainable, and compare that with the overall profit margin of the company. I think that will give a good starting point. I think I'd want to bring in my colleague Anke as well, like to comment on that. And I think we'll be going back and forth with I think looking at that initial part. Anke, if you, I don't know if you could give us some of your view as well, that'd be excellent.
Yeah, thank you. And thank you for the kind introduction, Tarun. I really like your first slide, Tarun, because what I really like is that you list the income approach, the market approach, and then the relief of royalty method separately. We have a lot of books where we have only the three approach: cost approach, income approach, and market approach. But from my point of view, the relief of royalty method is a combination between the income approach and the market approach. So we have definitely a lot of arguments why we put it separately, and we try to like make everybody kind of clear that we have here a mix, and with knowing that, we know what is really where do we really get the parameters from. And this is what Fernando just pointed out, because for us it's always very important to be in the realistic world, and like where we have transactions, where we see prices, and in terms of IP, we kind of seldom see real prices or transactions, because quite often they are very confidential and they are not announced like we see it in, for example, merger market for company transaction, M&A transactions or mergers. But we see the prices in license agreements. And this is the whole idea behind this approach, that we have a real market transaction in a license agreement. And then we say, okay, we have a marketable IP, either it's a brand, it's know-how, or it's a bundle of several assets. And then we start at that point. And then we have the combination indeed of a realistic market approach. And well, the question, is this a realistic approach or not, is in our one of our next discussion points, meaning choosing carefully your assumptions. But the idea behind this, we observe something in the market, and then very important for us from a valuation point of view, we do not look in the past, but we look in the future. And this is the separate the combination with the income approach, projections in the future. So as we all say, for the past, we do not give a penny. We only want prospectus. We only want opportunities. So this is, I think, a super starting point to make clear what we are really talking about.
Yeah, and if I just made to compliment, which I think is brilliant, that's absolutely right. The relief from royalty is you look at how transactions have been done, what royalty rates could be applicable in your specific area, and the future income approach of looking at what are the future cash flows. The other thing that I just wanted to highlight for everyone, because when I think about valuation or the definition of an asset, I just think sequence of future cash flows. So those cash flows can be positive, negative, or zero. But we're trying to work out with all valuations is what is that sequence of future cash flows, and what is the probability of obtaining those future cash flows? And what's the time value of money to try to achieve those future cash flows in terms of time and risk? Yeah, so that's where the discounted cash flow element comes in. I think, yeah, so I think that's absolutely brilliant. One thing that I always do when I do these valuations as well is think about the cash flows, the free cash flows to the firm. And I saw there was a question here of one of the colleagues said, how do you think about a brand or a domain name? I think royalty rate. Yeah. The way I think about it is the following. I think about the overall revenues of the company. I look at the overall profit before tax numbers of the company. I look at that profit margin of the company. And let's, for an instance, just assume that the free cash flows are just like the profit after tax figures. If I discount that cash flows, then I'm trying to obtain an estimate of the value of the business opportunity of the company. Now, the way I think about the intangible assets is you could list all the assets under the company and try to estimate their importance and rank them by importance. And then it's a matter of saying, what are the transactions in the marketplace that are sensible in terms of royalty rate, but what's your also interpretation on how those assets underpin the overall company? So that can be an exercise from 0 to 100%. You can say, well, the patents are extremely important. This is a biotech. So how much of that profit margin are those assets underpinning? Maybe the domain name and the website are instrumental because you can, order things there. That's your route to market. You can bill through that. It has complicated software in the background. So then again, maybe that's your most important asset. It really depends. But I submit to everyone to think about, in your case, what are all the assets and what are the most important ones? And then have a comparison. Does that sound realistic in terms of if I were to, license this in? And does that make sense? I'll just because over the years, I came to this realization as well. Let's just go back to the free cash flows to the firm. If I discounted those cash flows, I get the firm, the value of the business opportunity or company. If I then start out with a royalty rate, which I multiply times the revenue, and I get a cash flow line for the IP assets that I'm interested in, and I compare that cash flow line with the overall cash flows to the firm, and let's say for theoretical purposes, those are the same. What that means is that royalty rate that I chose is valuing the entire company. It's not valuing assets that are a section of the company.
Yep.
Yeah. So I think that's the core of the analysis as well, at least when I do things. I don't know, Tarun.
Yeah. So from a parameter perspective, if we break this up, right, there are several components in terms of identification of the royalty rate, which in all likelihood would be, based on what's going on prevalent for that particular technology, for that particular market, for that territory in context. And there are probably enough baselines available. However, when we look at the projections to be done for a certain period of time, that period is, people say it's the economic life of the patent, right? And there'll always be that subjectivity associated as to whether the economic life is for 8 years or for 10 years. The patentee or the IP holder would obviously believe, that the economic life is as much as the legal life is, for instance. How do you balance that on that very limited aspect of for how many years do I project?
Yeah, it's a great question. The starting point is, before thinking about the actual valuation exercise for sure, is to confirm ownership of the assets of a person or the company, and then to confirm, well, what is the let's say the patent lifetimes, what was the filing date, right? And how long do we expect this to last for? So that is the start, because at least, or in any other asset, we can take software and we can ask, how long will the software asset last? And then maybe the company will say, it'll last for 2 years only, or for 5 years. So that will help us gauge, how far we should project. That's in terms of timeline. But when you ask me, how far should a company project, right? It really depends on who you're talking to, right? And what the exercise is and to who. So if it's for internal purposes and you think you have a good sense of, what the forecast should be, that's fine. But sometimes if you're going to go for investment rounds, sometimes they'll only believe 1 to 2 years, maybe 3 years maximum, right? I mean, especially if you're pre-revenue. If you're already an established business, maybe you can extend that out. But if you're not, it all comes down to, remember what I said, what is the definition of an asset? It's that sequence of future cash flows. It's what's that probability. So when I do these exercises with someone and they send me like some financials, I basically say, well, okay, walk me through all your supporting evidence that you're going to get this. Let's take the best case that they can say. They can say like, look, I don't sell any products and services, but I'm licensing my patent currently for this rate for 5 years. Yeah, then that's really good, right? You have a license, you have a transaction, you have a rate, and you have an estimate of how much that you're going to receive. On the other hand, if it's very early days and you're forecasting, 90% or 80% of the valuation is looking at those cash flows, saying how realistic are those, yeah, and then working out the royalty rate that's also that you can substantiate. But I would say that, yeah, I'd go through and meticulously dissect. I mean, it doesn't need to be like that if you're really just starting, right? So let me make that point. It can be very complicated or very simple. They're both fine. It's just making sure that you can substantiate your assumptions, you know, and that they're credible, and that you're going to hit the probability is high that you're going to hit that. Anke, I don't know if you have other elements on that key point, because I think that's the core, right? I think of analyzing what's the probability of cash flows.
Yeah, definitely, and maybe coming back a little bit more on the specific issue. What are you going to do with your specific lifetime in evaluation? Well, as you said, Fernando, we have to use the data regarding comparable royalties based on what we do in our research. And very seldom you'll find a kind of a long-term license agreement. You always have the chance to terminate that. And then the problem is, how do you adopt this to your valuation case? And here, I think, to bring on up another aspect, we have to distinguish what kind of agreement do you have in front of you,
Mm-hmm.
Comparable. And a very typical case for royalty-based valuation is the valuation of brands. Yeah. And here it's very interesting because when you look really more carefully on the agreements, and this is why I'm really I really base my valuations only when I have also the agreements in front of me and I can see all the details and not only 1%, one number, but you really need the full information about your comparable. And if you look at that, in the example of brand valuation, you can really identify, you have to identify who is in charge, for example, for marketing. Yeah, look at B2C brands. If you do not invest any longer in marketing, the brand will be dead at a certain point of time. If you have a trend, a very like a popular brand, and you do not feed it in any channel, then everybody will forget about this, and the value of the awareness is gone quite quick. So if you really look carefully on brand royalties, then you always have an agreement between licensor and licensee who is responsible for what, how many marketing expenses has to be, for example, spent by the licensee. Then the royalty for sure is a different amount compared to you are in a situation where you have a very well-known brand. The brand is also used by the licensor. The licensor also spends marketing as it's a well-known brand. And so in this point of view regarding lifetime, if you include the marketing expenses, then the lifetime where you look on your brand is different compared to you somehow do a simulation. What happens if you stop marketing, for example? Yeah. So considering lifetime, I think you have to be more specific on the IP you want to value.
That's brilliant. And I'd even extend that really nice analysis that you did, Anke, and say patents the same, right? You could have a lifetime of, let's say, 10, 20 years, but if you don't pay the maintenance fees, then they collapse. You could lose the right? Or if you're not selling or, generating revenues in specific jurisdictions, also you might lose the right to use maybe a trademark as well. So there's several considerations. That's absolutely correct. I think that's why it's so important to think about what are all the assets that the company is made out of, and again, what is the competitive advantage, or how does that help you with the value drivers? But Anke touched on a point that's really interesting. That reminded me as well, like when somebody asks, like, what's the most 3 important things? Because I do a lot of valuations for investment purposes, right? For people that are trying to get equity or loan investments, list in stock exchanges, etc. And sometimes they're at any stage, if somebody asks me, what are the 3 most important things that you think about in the valuation? And I think the 3 most important things are team, team, and team in a way, because it's all about the execution. You could have the best things, right? But if you don't have the execution, then that probability of obtaining your future revenues and cash flows will not be there, right? So you have to, and then what's the support? So I look at risks of, are they going to get the investment necessary? Do they have the right team? Have they done it before? Are they going to be able to ramp up? Do they have the connections? Do they have the supply chain? Do they have patents that are granted in specific jurisdictions? All these things then work back on risk as well, right? And attainability. Someone kindly asked also, I think on the chat, if I just go to that question, says how to measure sales-based royalty license rates when the licensor has no control to verify the sales data. Isn't an interesting point? I think it'd be very difficult. And I can't give advice here, but my general thought when I read this is you want to have control over, you want to have the license royalty rate attributed directly to sales, because that's the one thing that you can hopefully look into. If it's attributed to any other aspect, it becomes a lot more difficult for you to control, right? If it's operating profits or anything else other than sales, ideally you would have the sales number. And if you go into, Ankit probably has a lot of experience in this as well, like you try to estimate what is a potential infringer sales to try to work back, what is loss of profits. I think that's what the one thing that people can actually, it's at least straightforward, right? That you can think. So I would try not to get into a license agreement that you don't have the royalty rate attributable to total revenue or sales, or else you're right. It's very difficult to control, right? It's very difficult to measure.
Yeah, I think that's one point we discussed before we started the webinar, Tarun. When we use the information from other royalty agreements, and then we don't just pick out the royalty rate, but we need to do in German we say calibration. I see in the decisions regarding front licensing, they call it unpacking, which means that we have like caps, floors. We need more financial data of the license partners themselves, as in the question here regarding the sales volume, in order to identify what is really like the blended normalized license rate. And this is quite often a very great problem, because we do not have a transparency about what's really in place. When you really live this contract, we only have the contract most of the time. For sure, we have some databases depending on the license partners, where we have like public financials, but quite seldom they are so in detail as we need it, and only with regard to a certain asset, or at least a group of assets. Tarun, do you want to add something to that? Because I think you know about these unpacking issues.
No, I mean, you're absolutely correct, right? I mean, in totality, I think we've seen for a given technology and for a given IP in specific, valuation ranging from 5 different firms from $1 million to $100 million, right? So it's always very, and as whenever we undertake valuations, it's always the conservative approach we take, that, okay, these are the bare minimum sales you'll be able to achieve in the worst case scenario. So, we never take the best case because there's no end to what the best case could be. But when you're obviously on the worst case, then at least your marginalization and the conservative approach, you can defend your valuation a little better from my perspective. But to counter, not to counter, but then just to sort of maybe reiterate one more aspect that I thought I'll get your inputs on, Anke, was when you're doing these valuation exercises, apart from the projections of the sales or revenue figures, whatever numbers that you are sort of looking at the very top hierarchy of it, and the royalty rates, and you look at 2 or 3 or 4 valuation reports coming in from different stakeholders, what other parameters or assumptions that are made vary, or the valuation so drastically different between the entities that submit or would perhaps do valuations? What are those 4 or 5 other assumptions that they make, which could drastically change the whole approach towards the final outcome or the final valuation number that would come out, apart from the projected sale values and apart from the decided or whatever you've decided that the royalty rate would be?
Yes, it's a little bit more technical question, but I think the example you showed in your slide in the beginning is a quite good backing for that, because in addition, what we need for sure is a specific discount rate, and the determination of the discount rate for IP asset valuation is really a big issue. And as far, I mean, we have certain methods and we have ideas, but it's still not so much standardized as I see it, for example, for a company valuation. So one parameter beside projections and a lifetime and the royalty itself for sure is the discount rate. And well, for sure we have the tax rate, because we always do a after tax calculation. I think this is the assumption, which is the one which is the easiest one, because we check on this point of view, where are the cash flows, and so I mean, you can do it complicated as well, but this is much more straightforward compared to and this is my point of view, the most critical issue is the royalty rate itself, or the royalty. And saying this, I think if you just remember your slide with the calculation, that's more or less is it, but changing the royalty rate, the projections, and the lifetime can cause really huge ranges. So these 3 assumptions from my point of view are really all the same highly critical, because the value can go in so many directions. So you really need reasonable assumptions, a good backing, and also what we do. And then I hand over to your ideas, Fernando, if you agree on me or not, so tell me. But I think it's very important to have a second sanity check. Yeah, so we never do like a valuation, then you have a result, you say, oh, okay, that's the range or the value. We always say, okay, and I think that's the idea you had in the beginning, Fernando. We go back and we say, is this economically reasonable? Can this be, does it make sense? And then we look at this same valuation problem from several sides. So Fernando, what do you think?
No, you touched on so many interesting points. I think the first one I also ask, colleagues that I'm working with this, let's say if they're on, they're asking for the valuation, I ask them, how much would you pay? Right? To acquire your own IP assets. What's, if you had to make a transaction today, and I do that sometimes in, when I give lectures, right? I mean, they'll have an undisclosed item and they say, okay, we're going for a bidding. And let's say who could bid more for this? You have limited, that I'm teaching, I'm here at this university. It should be a good prize, right? But that's all right? And then the bidding starts. But then that's the market at play, right? But then I always ask companies that as well, saying, or clients saying, how much would you actually pay if you had to, pick the money out of your pocket and actually do this investment? Which brings to the discount rate question as well, right? Which I think absolutely. I mean, I was just talking about this exact thing just now. My sanity check is comparing it with company transactions and thinking, does that sound reasonable? Or does can the IP really be that much of the company value or not? That's my main one. But the other one in terms of the discount rate is like this. So there's different risk profiles for different returns, right? And you can have a portfolio of assets, but I'll just give this simple example. You can have cash at home, right? And let's say under the bed as an example, and then you're not going to get any kind of interest there, right? But then you're not hopefully you're not going to lose, you're going to lose maybe to inflation. But then you say, okay, I want to invest this in another asset. So you might invest it into bonds, right? Which are secured. You know when you're going to get them back, you know the rate. So that's what we call risk-free rate. So here in the UK, it's about 4.6% is I think the 20-year bond, yeah, or gilt yield. So you're expecting to the discount rate, or the amount that the discount rate is another way to think about your desired return, yeah. So my desired return is 4.6, so I'll invest in bonds. But then so when we do these exercises, instead of, we're not investing in bonds, we're investing in IP or companies. So then we say, okay, what if I invest in the entire stock market, right? What is the premium? How much do investors that invest in the entire stock market want to make above the risk-free rate, which is the bonds? And then you can look at the entire stock market and say, well, the average is around 6 to 8%, let's call it 7%. So somebody that invests in an ETF fund, an exchange traded fund, which also you're investing in all the companies in the exchange. So you're de-risking yourself quite a bit. You're not investing just one. You're expecting to make another 7. So 4 plus 7, let's say 4.5 plus 7 is about 11.5, right? As a starting point. Then you think about, okay, but I'm not investing in the whole stock market. I'm investing in a specific company. Is this company a public company or is it a private company? And how big is this compared to these other companies? How much riskier is it? So there's all sorts of measures on small company risk and company specific risk. So normally how I do this, I separate market risk, which we've done so far. So applying on public markets. And then I think, what is the premium that I want to get back as an investor or as a person, right? If I invest in actually this private company now, right, which is not liquid, that will have higher risks. So it's an additive process. And I'll just extend that out to saying, okay, this is what I want to get. But now look, I'm not investing in the company. I'm investing in IP assets. And if I'm going to be valuing them isolations apart from the company, that can create much more risk. So that's another element that I have to, so you could say, the 4 plus, I'm just giving a theoretical case, right? So not a specific case because you have to analyze each situation. But you start with 0. And then if you invest in bonds, 4.6. If you invest in the general stock market, then that's, an aggregate of 11.5. If you invest in a small company, normally it goes up by another 11%, let's just say. So if it goes by another 11%, then it's 22.5%. But maybe the IP is really risky, right? And then I said, look, I honestly think this should be double, right? It should be maybe 50%. I mean, this is where the sense of how risky an asset is. And a lot of things that come to mind, is it generating cash flows or is it not? Are you selling this already or are you not selling it? Do you have contracts in place or you don't have contracts? As Anke said, how are your contracts? How solid are those if you get into any kind of issues, right? And all of that will be used in order to arrive at the discount rate. The one thing that's important is valuation is of a certain date. So we value today. So it can change tomorrow if you get a license or if you get a sale, right? It's like stepping in the river, right? You never step into the same river twice. So it's always different. And then you just have to sit back and say, have the conditions changed? How have they up or down? How have markets changed? All these things will then help you with the discount rate. Just discount rates now is doing this company. We looked at it 3 years ago. Now we're looking at it again. It materially changed, from that period to today's date. So that would be my recommendation.
Got it.
I really like your approach, Fernando, because what I said before, doing the sanity check, it's what you described and with more detail. So this is really, I think, an excellent approach, because we cannot. It's not like calculating very with accurate numbers, because it has to be a qualified estimation most of the time. And what you just described, it's brilliant to say, okay, we start and we look on it more on a broader way, and then narrow it in several steps. Sorry, Fernando.
Oh, no, that's perfect. The other thing that I would say, and I get asked about this a lot, right? Because sometimes it's well, a lot of times it's for investment purposes. And although you've arrived at a value, the things that I'm thinking about is like, who could acquire it? Could it be a management buyout even, right? Who are the competitors? How much would they be willing to pay? But importantly, if they run into trouble, and this happens a lot, right? And they have to divest the IP assets. What is, what is the worst case? And then you can apply maybe insolvency or a distress sale discount to that IP value. Be like, look, just to put everyone in perspective, if you run into trouble, if you start running out of cash and the company it becomes insolvent and defaults, you could be thinking of recuperating maybe 10. I mean, I've seen this all the time, right? Maybe 5%. Some companies recuperate only 1% of everything they've invested, which is crazy, right? But that can happen, right? A lot of biotech firms that I look at, they just run out of money. They haven't been able to reach commercialization. And then it's a liability. So the other person that's going to buy it is going to offer it very, very low value. So just keep that cross-checking your mind on, again, what will somebody pay for it? That is the true valuation. Once that transaction happens, considering the circumstances, whatever they may be, really good prospects, more or less, or very distressed, that's how you should think about that. So you can still arrive at a valuation with a high discount rate, but then you can say like, look, I'm going to discount it by another X% because I think this is not going in the right direction. Correct. Yeah, so that's quite important.
So, I mean, before we come to the final section on the case studies, perhaps a couple of them coming from both of you, one more parameter that also plays in mind is when you're actually projecting the royalty rates over the period of the life of the economic life as we look at, the royalty rates may vary as well as we move along. What considerations would you usually have in mind owing to which the royalty rates would maybe start with 4% and 3 years down the lane go to 3.5%, and perhaps by the end of the economic life be at just about 1% or so? What considerations would usually play in your mind? Maybe 2 or 3 considerations, and then we move to the last section. Any of you?
I can start then. The first thing that comes to mind perhaps is this: what is in the contract, right? Is the royalty rate banding linked to number of sales, right? So the more I sell, maybe I receive a slightly lower royalty rate. That could be the case, right? If you're, I mean, computer chips are probably like that. I'm working with another companies that sensors. They have that, right? At first, they have a really high royalty rate, but it's low volume. As they scale very highly, then the volume comes down, but the sales are like they're really high, right? So it just makes sense when they get that kind of economy of the scale. I think that's the exception to the rule. So the first thing that I would check is, do the contracts stipulate any kind of royalty banding? And what are they? And hopefully that's attributed to sales. If that's not the case, because everything is an assumption, everything is a forecast, I try to keep, personally, things simple. Yeah. And I try to work with the client saying, well, do you think this is sensible first? Do you have any expectations of it going down? But the other thing in the beginning of the talk that I talked about, immediately I'll think about, okay, what is the expected profit margin of the business going forward? And if that goes down, the royalty rate will go down, right? It just makes sense to me. If we make the assumption that the royalty rate will reach a maximum and then stay steady there, then we can have a good analysis. That's how I do it, right? But if all of a sudden I think that, there's other competitors coming in, the profit margin is being driven down, that's a red flag, right? And then you say, well, maybe that royalty rate that we thought about in the beginning where it would be supportive no longer is applicable now. But these are very specific cases, I would say, right? in the general rule, you don't have all that foresight of trying to predict, but you can do this analysis in a way back. There's a couple other questions. It says, what methodology is used by banks for securitization against IP? The one thing that I would say here is this. I do this quite regularly, but we come up with a value and then we come with a very heavy distressed sale. Yeah, value. Because the bank, they're not like equity investors that they invest in 10 companies and hopefully one will pay 10 times, the return. Banks, they have to, I mean, they'll lend out of that case that I mentioned, mostly software assets or patents that are being licensed. The revenue stream is very, very clear to them. They can service the debt, or the company has a lot of money, a lot of revenues to service that debt. And that then they can perhaps securitize the IP. But they really have to have a lot of confidence that the IP is going to retain that value. And normally I would just apply like a distressed insolvency case scenario, say like, look, this is the lower side of things. And just be aware that if you invest, you might only recoup a small portion of what you invest. But normally banks would not lend in the similar ways as private equity or venture capital or high net worth individuals. There's another question here. If the IP buyer expectation of return is high, then IP value will be less. Sorry, yeah.
Maybe to stay with this question, because
of course.
The German point of views might be a little bit different, but then we can go on to the next question.
Please. Sorry about that, Anki. Yes, awesome.
Yeah, sorry. I know you're in the valuation flow. I know how this feels. Yeah, so passionate about our issues. No, regarding IP as a security for banks, I think they really love to have a lot of assets sitting in the balance sheet or not being visible. So what we have on a very regular basis is that the banks need expert opinions on that, and they use it for their own securitization policy. So this is where you do not have any advice, but you have to really act as a neutral expert.
Good.
And for example, in Germany, we have certain standards. I'm pretty sure you have similar things in India, or you use the international valuation guidelines specific for IP valuation. So I think these types of valuations have to follow certain rules in order to show, okay, these are the principles, and these principles are nothing really different from what we discussed, Fernando and myself, in the session here. But we are kind of tied to these standards when we do evaluation for these purposes. And I agree with you, Fernando, that it's more like private equity, and it depends who is really interested in the asset and needs it for what kind of financing. What we see quite often here is brands, like a whole trademark portfolio as security in bank loans. And I think that's probably one of the ideal assets that can be used, because in any case, depending on the brand, the exploitation of a brand portfolio is a little bit easier compared, for example, patents, because patents are always tied to know-how, to certain other products. Patents can be on very specific, small, tiny things in a technology. So it's kind of difficult probably for banks to exploit that. I mean, it depends. If you have the whole portfolio, it's also different. But brands is, from my point of view, the most popular brand IP, what you can use for that. Fernando, do you have the same experience, or?
Absolutely, yeah, definitely. I mean, it depends on the industry, right? Let's say if I'm looking at pharmaceutical, high tech, then the patent portfolio is important, but I agree with you. The discount rate can be massive, right? The brands is a lot easier just because there's so much more. Well, there's two things. One, brand is, as long as you continue renewing the fees, you can have the brand forever, right? Or for as long as you pay the fees. The patents has a limited lifetime. So brands, I think, are absolutely, that's what I've seen. Like a lot of companies that go under, especially if they're high visibility brand companies. The brand can be sold for a lot of money, even more than the consideration sometimes, because the acquirer can use that in their own. So it depends on in which hand the brand is in, right? The actual company or a competitor. So that's, I think, another thing that you can think about is you can estimate, well, what if this was in the hands of X that has maybe a bigger customer base? Then that will help you with your negotiations as well, right? Looking at it from your side, but then if you, I'm doing one actually right now. It's one of the largest sports companies in the world, and they went to they try to go into a jurisdiction that somebody actually had their own that brand registered in that country, and now they're talking about, look, you're of course you're the top sporting company in this country as well, but we want to come in. Can you sell us your brand? And then, but what does that include of rebranding? And this hire company is obviously thinking about that. Once we get a hold of that, we could do much more revenues than this smaller company here that has the right, though, right? So I think brand is awesome. Yeah, in that sense, it can really retain value, and we've seen it in the UK, right? A lot of department stores going bankrupt, and then their brands being sold by for a lot of money.
And regarding the question was asked, what kind of methodology is used? I think it's the same we saw, like in your first slide, Tarun. Usually you have all the three methods, and also as fourth method, the relief of royalty method. And my experience is that the royalty-based valuation is the most popular and most used method we have here, and for sure the same is used by banks.
Sure, sure. Understood. We can perhaps, because of about 7 minutes left with us now, we can probably open up the floor for colleagues who might want to ask, but there's one question that perhaps being asked by Mr. Jain. If the IP buyer expectation of return is high, then IP value will be less. Is this correct all the time? What's your view on this, Fernando?
I'm just trying to see if I understand the question. If the IP buyer expectation of return is high, then the IP value will be less. I'm not sure I understand the question, because how I interpret is the following. So if the IP buyer expectation of return, let's say, of getting a hold of this IP is high,
yeah,
I would think that the IP value also will be high. However, he would want to pay a reduced fee in order to actually get to his return. So maybe that's the interpretation that I make, right? When you're on the buy side, you want to buy cheap or on the low, and then do all the work and then try to get your returns, right? I think that's one consideration. So I'm not sure if it's...
Yeah, the intent is basically that the cheaper you get the IP, the more return you'll as a percentage be able to obtain when you actually start monetizing it as a buyer of the IP from the seller side.
No, definitely. I think if we angle it in that case, for sure. If I mean, and with any, I would extend that to any asset, right?
Correct.
So if you buy an asset or a stock or a share that you think is undervalued and that you expect it to go up quickly, yeah, your delta, your return will be high for sure.
Correct.
So if you can identify this will be quite good, actually.
Sure, sure. So I think we'll open up anybody who's any questions that might be there. Very happy to have them right now.
I think you can unmute as well if you like to ask the question.
If there are no additional questions, Tarun, I think we can maybe close the discussion with short statements in the end, and also refer to, there's one more question. How do we guide startups on the importance of IP valuation at early stages? Oh, that's a super question. We have a lot of pharmaceutical or biotech companies, and well, yeah, I think, well, the valuation issue is not the only critical one. The critical one is, it's quite one step ahead, is to identify who's the owner. I think the issue you made in the beginning, Fernando, because you always need the ownership at the right place, and then you, if for example the ownership is with the founder, and the business starts to fly and you want to go in the next steps, then you have to transfer the IP from the owner to the company. To be honest, this is really, from a tax point of view, at least in Germany, really an issue. So the value of IP, I think it's very important to discuss really in the beginning of like technology-oriented companies and startups, to be sure where it's the IP and and that it become really increase in value, and then it's important that it's in the company itself and not somewhere else.
Very well, very well. No, I'm very happy. Great, Anki, for sort of throwing out the light on that. And I think from the level at which we are undertaking exercises and venturing more and more as far as the Indian ecosystem is concerned, I think valuation will become an extremely hot topic in the next couple of years. And I think sessions like these will give a lot of insight as to what's happening at a global level, which by hearing the two of you today doesn't seem to be very, very different from how we guys are approaching it in India here. So it's obviously there are certain territorial tweaks, but nothing which is at a very fundamental level altering the methodology. But any last comments?
I'm just going to make a really quick comment. The one thing that I would say is the world has changed in a drastic way, right? And the most valuable assets of all companies are intangible assets or intellectual property. And there are several studies, academic, and professional and studies that show that an organization that can clearly identify them, manage them properly, invest in them, choose which intangible assets or IP assets to actually invest in, will have the largest value, right? If you look at any companies in the world, most of their value could be, 80-90% intangible assets. So I would say that not only from a very early stage all the way to a very sophisticated company, everyone needs to know this, right? The importance in the early stages, as Anke said, you need to have everything in place in order for you to scale, right? So you have to be aware of what you're developing. You have to have it in the right place. You have to have it in the right structure. And in all things, I'll leave you with this as well. In all transactions, you get to a value and then they think, what's the tax implication? And everything can be different when you think about that at a very late stage. So please take time to think, are these assets in the right place? Are they owned by the right colleagues? Is this how we're scaling? And there was another really quick thing that I wanted to mention. Oh yes, in finance, if we have to distill finance, it's based on two things, and I'll just leave you with that thought today. It's based on valuation and management. That's finance. Valuation is the starting point, but it tells you what choice will you make. You have two choices. Which are you going to choose? This one or this one, right? In order to make your decisions, transactions, day-to-day activities. Once you've decided which one's more valuable to you, then you can make that decision. So management becomes easier. But finance is really that. You value something, either economically or in your mind or whatever you think is best, and you make that decision. Right. So valuation it's everything. I mean, we do it all the time, even subconsciously. This is just going a little bit more in detail to the granular level of a specific asset, which again, I leave to, is just a sequence of future cash flows or future benefits. What's the benefit to you or to others from that perspective?
True. Absolutely. Anke, anything from your side? Last comment?
Yeah, one last comment. You said the IP valuation will increase in the next future. I fully agree, but to be honest, it was not boring in the past 25 years. I'm doing IP valuation, and it's really a very interesting topic. And so, yes, we have additional assets like data valuation. Also, ESG is also a kind of intangible asset. So I fully agree with you. There's a lot of work to be done in future, and I really enjoy doing this complex valuation work. So thank you for inviting us for this webinar, Tarun.
No, it's been an absolute pleasure. We could not take, owing to time, some questions from Mohini and from Mr. Shankara Rao as well, which I'll try and take offline later on, or probably bother you over the email. But a sincere pleasure. I thank LESI for the opportunity of being able to gather up for a topic of this relevance. And thank you very much, both of you, for joining in. It's indeed a pleasure, and I look forward to having many more of these sessions in time to come.
Thanks,
Thank you
Tarun.
for-
Thanks, everyone, as well.
Thank you.
Thank you. Take care. Bye.
Thank you, ma'am. Bye-bye.
Thanks. Bye-bye.
Thank you. Thank you all.
See you.